Hi, everyone. I'm Todd Rosenbluth, the head of ETF and mutual fund research at CFRA. Thanks for joining us as we talk about sector investing and specifically how to use CFRA's What's Inside Our ETF research methodology to help you to build portfolios. It's been an interesting year in 2020 as equity ETFs and equity markets in general have been down. The S&P 500 and S&P 1500 are down double digits this year, but it's even worse if you look at certain sectors. Specifically, the energy and the financial sectors are down more than 25%, and in the case of energy, down more than 35% since the start of the year. But there have been bright spots. The healthcare sector is down just 2.5% when we look at the S&P 1500, and the information technology sector has actually been up 2.5%. These two have been really strong bright spots, and you as an investor and you as an advisor can be able to build your portfolios looking forward using the past as your prologue. In fact, CFRA has overweight recommendations on the information technology, the healthcare, and consumer staple sectors as we look forward, and we have an underweight recommendation on energy as we look forward, as we believe there's more pain to be had as oil prices remain low and the challenges for some of the large and small cap companies are hit hard. The financial sector, the fourth one that you'll see here on this screen, is one we have a market weight rating on. So we do think you should have meaningful exposure to it, and we're going to talk about one way you may be able to do that using ETFs. Let's start here on the information technology sector. Information technology is the largest of the sectors, and the Technology Select Sector Spider, XLK, is the biggest of the bunch. We at CFRA have a 5-star rating because even though the portfolio is relatively concentrated, more than 2/3 of the assets are in the top 10 holdings. 8 of these holdings are either CFRA strong buy or buy recommended stocks from our equity research team. Similarly, 8, not necessarily the same 8, of these holdings, these top 10 holdings, have favorably low CFRA earnings scores, which to us gives us confidence that there's underappreciated earnings potential. You're going to find some of the stocks you quite likely own individually within your portfolio. Stocks like Microsoft, Apple, Alphabet, Visa. These are the heavyweights within the tech sector, but you get the benefits of diversification across all of them and many more with the tech sector ETF for just 13 basis points. Now, the second ETF we have here on the screen, PSJ, this is the Invesco Dynamics Software ETF. You're going to get some different exposure. While the top 10 holdings is roughly half the portfolio, and we at CFRA are bullish on about half of those top 10 holdings, 5 of them, these are different holdings. So while you'll find Microsoft within PSJ, you'll also find some more moderately sized companies like Activision Blizzard, Electronic Arts, and Adobe, a mixture of tech as well as communication services companies. You'll also find some healthcare stocks, although to a much smaller degree. Now, this ETF, unlike XLK, comes with a higher fee. The expense ratio is 58 basis points. So that is a premium to get a more targeted, more fundamentally focused approach to the technology and some other similar sectors. But it's one that we at CFRA find to be appealing. Let's stick here on the healthcare sector ETF and Healthcare Select Sector Spider as one way to get exposure to this overall space. And the ETF XLV is a great way of doing that. The top 10 holdings is just over half the portfolio. And again, CFRA is bullish on many of these top 10 holdings. Companies primarily in the pharmaceutical sector is the largest. So Johnson & Johnson, Merck, and Pfizer you'll find within, but you'll get some diversification through companies like United Health Group and some biotechnology companies like Gilead Sciences, to name just a handful. This diversification comes at a very low fee. Again, 13 basis points. This is the fee that you tend to find with the healthcare sector ETFs, as well as the other ETFs that State Street offers. A more targeted approach, specifically on medical devices through an iShares ETF, is appealing to us at CFRA as we look forward. IHI holds stocks that we find to be attractively valued, including Abbott Labs, Medtronic, and Thermo Scientific. These stocks are either strong buy or buy recommended, and in many cases, these have favorably low earnings scores. Now, not surprisingly, the more narrowly focused ETF gives you a higher expense ratio of 43 basis points, but this is still appealing to us. You can go and find some more targeted ETFs that are appealing despite this premium fee. The energy sector, as we mentioned earlier, is an underweight recommended from our top-down investment strategy approach. And the Energy Select Sector Spider, XLE, is relatively low rated compared to some of these other cheap Sector Spider ETFs. It earns a 3-star rating. Now, it does so because CFRA finds there to be high quality of these earnings from these companies. So Exxon and Chevron, these are highly concentrated within the portfolio. Nearly half are in just these 2 stocks, but you get some diversification. EOG Resources, Kinder Morgan, these are buy recommended stocks according to CFRA's equity analyst. And this low fee helps to offset the relatively low reward and high risk. So we do think you should have exposure to energy, and this is a relatively strong way of getting energy exposure, specifically compared to the one we have also on the screen, XOP. This is from State Street also. It's the S&P Oil and Gas Exploration and Production ETF, and it earns a 1-star ETF. We highlight this in part to show you what to avoid, but also that CFRA's independent research gives us the flexibility to go negative on such a relatively large ETF. Now, Exxon and Chevron you'll find within the portfolio, and this is equally weighted, so they're combined about 7% of the portfolio. But you'll find more small cap companies within the energy space, companies that have more stretched balance sheets that we think are relatively high risk. And this expense ratio, again, is relatively high compared to the Sector Spider ETF. So if you're looking at XOP, we think this is an ETF to avoid. Lastly, the financial sector. We touched on earlier that this is a sector that we think investors should have some exposure to equal to the broader market. So we have a market weight rating on this ETF. XLF is the Financial Select Sector Spider ETF, and it earns a 2-star to us. You're going to get exposure to banks, capital markets, and insurance companies in particular. The fee is relatively low, but we find, again, the risk not to be rewarded as we look forward. But if you are going to have exposure, we think iShares U.S. Financial Services, ticker IYG, is a more favorable option. This ETF gets a 4-star. Again, relative to XLF, we think this ETF has a higher probability of outperformance. You're going to get a little bit more exposure to banks like JP Morgan and Bank of America, but you're also going to get some technology exposure. So companies like Visa and MasterCard that are classified as technology companies, but are certainly exposed to the financial services trends within the industry, is to us a more favorable way as we look forward at the underlying holdings. So we think that those stocks add to reducing the risk profile of IYG and make it a more compelling ETF as we look forward. Now, hopefully you've seen sample reports from CFRA, but we're showing them on the screen. And you can see the XLK ETF and the IHI ETF visibly here. Each ETF gets a cost, a reward, and a risk score. The higher the score, the better. So that's contributing most favorably to the overall rating. We're combining our forensic accounting and our fundamental approaches to the security selection, and we're using machine learning techniques to make our quant model smarter month to month. So we update our research each month, and the model learns from itself. The equity analysts covering the stocks will update their recommendations on companies like Johnson & Johnson, like Bank of America, like Microsoft, based on the fundamental and valuation trends as we look forward, as opposed to just relying on an ETF methodology that focuses just on past performance. Because we at CFRA believe that the fundamentals and the valuation of the holdings matter. I hope you found this to be useful, and you can learn more about CFRA's research visiting our platform, MarketScope Advisor, and you can contact us at one of the ways that you see here on the screen. Thank you, and have a great day.